if we touch on Bitcoin for a second, I agree with you. It doesn't just solve all these problems related to energy or other things like that. Basically, what it is it's an alternative ledger. So we talked before, going back to Jevons in the 1800s, most frictions in finance were solved by another layer of centralization. And Bitcoin is basically an alternative at the base layer. So it's kind of an alternative to central banking. So instead of just everything kind of tying into the Fed, it ties into this more distributed node system of nodes and miners, and then things can, layers can and do build on top of that. And basically, it's a way of operating a ledger in a distributed way. And it didn't just come out of nowhere. There was, going back to David Chaum in his Berkeley dissertation in the 80s. It was about how to operate a database or a ledger by mutually distrustful entities. So,
welcome to Tesla Hype, everyone. There could be a significant breakout in Bitcoin's history this year. According to Lyn Alden, prices will rise above $200,000, only about $165,000. New coins are produced annually due to a supply and demand imbalance that is unprecedented. However, companies, exchange-traded funds, ETFs, and institutional buyers are acquiring far more than that, while exchange-traded fund inflows continue to grow and demand consistently outpaces supply. MicroStrategy has amassed hundreds of thousands on its own. Lyn Alden claims that this arrangement creates the conditions for a rapid and steady rise that might occur far sooner than most people anticipate. Given the limited supply of cryptocurrencies and the growing number of buyers, the market trajectory of Bitcoin might be about to undergo a major shift.
sure. And for the years that I've been covering the space, I've been pretty bullish on Bitcoin and bullish on the growth of stablecoins, but then pretty bearish on most else in crypto. So I faded most of the themes other than those two. And I continue to hold those views. If we touch on Bitcoin for a second, I agree with you. It doesn't just solve all these problems related to energy or other things like that. Basically, what it is it's an alternative ledger. So we talked before, going back to Jevons in the 1800s, most frictions in finance were solved by another layer of centralization. And Bitcoin is basically an alternative at the base layer. So it's kind of an alternative to central banking. So instead of just everything kind of tying into the Fed, it ties into this more distributed node system of nodes and miners, and then things can, layers can and do build on top of that. And basically, it's a way of operating a ledger in a distributed way. And it didn't just come out of nowhere. There was, going back to David Chaum in his Berkeley dissertation in the 80s. It was about how to operate a database or a ledger by mutually distrustful entities. So how do you make a distributed ledger or database? And then there's tons of things building on top of that for the decades. All the encryption pieces had to fall into place. The global bandwidth had to get sufficiently good to allow something like this to be actually workable. And all these kind of pieces gradually came together, and then someone finally kind of put enough pieces together, kind of almost as early as the technology would allow. And now it's been growing for 16 years through various boom and bust cycles. Anytime something has upward volatility, it attracts leverage and euphoria. You get a period of downward volatility. We've gone through something like 4 or 5 of those now. Yeah. There are multiple 90% drops. The latest ones have been a little smaller, which is generally what you'd expect when you're talking about $1 trillion asset rather than, multi-million or multi-billion-dollar asset, more liquid, more distributed. But volatility risk is already there. A lot of analysts, they kind of view Bitcoin as a line on a chart. So, like they mentioned, it's an investment. They think it might go higher or lower. My involvement in the space for years now is, because I'm also involved in Bitcoin Venture with Ego Death Capital, Jeff Booth and others. I talk to founders throughout the space that are actually building things on top of Bitcoin. I talked to some of the core developers that have worked on Bitcoin for years. Those that actually publish the code that people use. I talk to, I'm friends with Alex Gladstein of the Human Rights Foundation. And he's great, isn't he?
Yeah.
I talked to him, and also not just him, but I talked to some of the people that they work with, people that are operating in very inflationary or authoritarian regimes, and kind of see what they're doing with Bitcoin or stablecoins to bypass their local issues. So basically, it's this kind of this alternative system that exists for them. Going back to stablecoins for a second, basically for years, for a long time, there have been the idea of offshore bank accounts. Wealthy people, in countries in the world can have accounts somewhere else. It's not something that's available to, the middle class or working class. Stablecoins kind of take that technology and minimize the overhead. So they say that kind of everyone can have an offshore bank account now. Is basically what a stablecoin is. It's a token that trades on some sort of blockchain. It could be Ethereum, it could be Tron, it could be a layer on top of Bitcoin. There's multiple places where they trade, and they're backed by T-bills, dollars, bank accounts. Various entities can offer these, and they might have different levels of trust. But basically, it's these pools of dollars and dollar-denominated tokens that are redeemable for dollars, at least by large entities. Not the number of dollars, no. It just kind of affects where dollars are. And so, generally speaking, for a stablecoin to be created, someone wires dollars to a stablecoin issuer, and then they get stablecoins. And those are the large entities, and then they're the wholesale, workers of them. So the ones that are done properly are pretty stable, because unlike Bitcoin that has its own fluctuating price, it's not redeemable for anything. The market is just kind of assessing what is a Bitcoin worth. Stable coins have a mechanism to make them stable toward the dollars. They're arbitraged if they become temporarily disconnected from their peg. Limited amounts of other fiat stable coins, basically anything you're pegging with, which is mostly dollars. In the past, especially when they were young, I mean, stablecoins were invented in like 2014. In the early years, and often they were denied banking. So they'd kind of get pushed to the periphery of the system, kind of toward the gray area. And there were various things that would happen. And kind of, people would, I think, rightfully question the backing of them. As they've grown larger and more accepted, and somewhat more transparent, they've had a very strong history of maintaining their pegs. And if anything, they're more backed than a typical bank account is by short-term, T-bills, reverse repos, things like that.
According to Lyn Alden, cryptocurrency is experiencing one of its most prosperous periods ever. Large instances have been overturned, and banks can now interact with cryptocurrency businesses more easily. This indicates that rules are getting more precise. In the meantime, Bitcoin ETFs are shattering records and gaining fresh capital every week. An obvious imbalance exists. The rate at which institutions are requesting Bitcoin is far higher than the rate at which new Bitcoin is coming into circulation. According to Lyn Alden, this deficiency, in conjunction with the increasing demand for tokenization and stablecoins, has enormous benefits for both Bitcoin and the cryptocurrency ecosystem as a whole. He believes that the same wave of institutional adoption and technological advancement would benefit other assets like Ethereum and Solana. She believes that 2024 may be a significant year for the industry as a whole, with prices rising due to a shortage of supply as well as an increase in users.
I'm usually in the U.S. Your answer to your question, I don't, because when we look at stablecoins, the biggest users of them are non-Americans that want dollar access. Basically, for people that do have direct access to the banking system, including money markets, if they want, and other things like that, there's historically been less of a reason to hold stablecoins. The kind of the killer use case for stablecoins. So for people that, and I often come across this for Americans who say, why would anyone want a stablecoin? It's like, well, it's not really for us per se. It's for two main reasons. One, cross-border payments. So, for example, there's over 40 currencies in Africa. Imagine if every U.S. state had their own currency and all the frictions moving money around in the country. Latin America has over 30 currencies. Basically, these are generally more efficient cross-border transaction mechanisms than the correspondent banking system.
So it's a little more decentralized, yes?
I wouldn't say decentralized, because there's still a very big honeypot that's kind of holding the collateral that backs a stablecoin. But the mechanism to send it is generally more efficient, is probably the best way to describe it. That it's relying more on technology and less on manual ledgers. I agree with you. Going back to Basent's point, so the two main uses of stablecoins, one is cross-border. The other one, and this is the one that ties more directly into what the Treasury Secretary is saying, is that the other main use case for them is people that want dollars that otherwise have trouble accessing dollars. And that's going back to the offshore bank account thing that I mentioned. So someone's in Nigeria, they don't trust the local currency. Maybe they do like gold and Bitcoin, but they also want something lower volatility for the next month or 3 months, and they want dollars. Stable coins are an efficient way to do that. Like, for example, right now on this call, I could hold up a QR code, or you could hold up a QR code, and I could pay you with Bitcoin, stable coins, gold-backed stable coins, whatever you as the payee would want. And if, for example, if I hired a Nigerian graphic designer, there's any number of ways that I could pay her around her local banking system, as long as she's in a country that's legal for me to do that, which most countries are. It's tricky because we're touching on kind of a couple things in rapid succession here. But so I guess to tie some of this together, basically any country that's running a big deficit wants buyers of its bonds to try to limit how much devaluation is happening. Back to the Treasury Secretary's point, right now across the world, there's generally less either interest or other reasons. At the sovereign level, there's less interest in holding dollar assets, so treasuries in particular. There's been an uptick in these entities wanting to hold gold, for example. Generally speaking, from the bottom up level, there's been no such de-dollarization. So, for example, in the streets of Cairo, people still want dollars as much as they did before. And so when you're Scott Bessent, and you say, well, there's all this demand for dollars. Maybe their governments are trying to de-dollarize, but the people want dollars because there's network effects and liquidity and the branding of the dollar. Stable coins are a way to get, make it easier for them to get their hands on dollars, which around the margins can support the value of the dollar. That's kind of the way that they're looking at them is all these mechanisms to get dollars out there. Now, when we go to the topic of debasement, even when you get someone to buy your bonds and buy, wanting to hold your currency, as kind of the global reserve currency is generally pretty good at doing, there's still winners and losers from the system. Generally speaking, anyone who's not on the receiving side of the deficits is kind of paying for it with their debasement. And that could be people within the country, or that can be people outside of the country that are using that dollar as savings. And to your prior point, like this podcast is not necessarily just meant toward investing in any sort of significant way. But the other factor that often gets overlooked in all these discussions is that anyone's wage that's denominated in a currency, basically every contract that's denominated in that currency gets affected by printing decisions.
Yeah.
And so if the government kind of puts its thumb in one direction and they try to harden their currency, they'll benefit some over others. And if they do the other direction where they rapidly weaken the currency, they'll benefit some over others. And that's all of those that are either earning their paycheck in currency or those that are, say, smaller businesses that are selling goods and services for the currency.
According to Lyn Alden, Bitcoin is gradually becoming a more reliable asset. Compared to its early years, volatility has already been cut in half. She makes a comparison to the gold market's trajectory after the U.S. abandoned the gold standard. Over time, sharp fluctuations gradually gave way to more steady price movements. Lyn Alden believes that crashes with triple-digit percentage drops are most likely a thing of the past. When ETFs and institutional investors have adopted a position of market anchoring, deep long-term capital is permitted to enter the market during downturns. As a result, dips become less severe and dramatic crashes become more manageable. Pullback, according to him, Bitcoin has formally entered the institutional era. Continuous inflows are being made into ETH, the supply is being absorbed by major actors, and the price fluctuations of the assets are being more controlled. This shift, according to Lyn Alden, not only lowers the amount of risk involved but also lays the groundwork for the longest bull market in Bitcoin's history.